Hi and welcome to FreeX Financials. My name is Esteban Ferrarotti and I am lead financial analyst at the company. Today we are going to talk about cost monitoring techniques, effective strategies for managing business expenses. So let's dive into the video. So let's start by introducing cost monitoring. Cost monitoring enables businesses to have a clear view of their expenses, facilitating better financial decisions. By implementing effective tracking methods, organizations can identify unnecessary costs and ultimately leading to increased profitability and sustainability. So, if you don't track your expenses, you won't know what are you getting or where is your money going, right? And you will never know if you are expending your money correctly. So if you are being efficient, if you are being sustainable, if your growth it's sustainable through time, if you are hiring too much people, if you are buying too much inventory, if you're expending too much money in marketing and that money is not generating enough sales. So cost monitoring is key to have better financial decisions, right? So there are several techniques for cost monitoring that includes budgeting, variance analysis, and cost-benefit analysis. For example, now we are going to go through budgeting in the following slides. Each technique serves to provide clearer insights into spending patterns or support the implementation of cost-saving measures. Of course, there are some techniques that are more advanced and that also may require some financial knowledge, like for example the cost-benefit analysis, which basically helps you understand which are the financial benefits that you are getting out of an expense, like very useful, for example, for marketing expenses. But for example, budgeting is quite an easy tool to implement, and that you can implement it even though you are a very small business, right? So let's go into some of these. But the first thing you have to do before you implement a strategy for effectively managing your cost is to start tracking your costs. So understanding how to effectively track costs is crucial for maintaining financial control in your business. This involves categorizing expenses, utilizing the right tools, and establishing the realistic budget to ensure our expenditures are monitored accurately. So you cannot have a budget, and you cannot predict or forecast expenses if you don't track the current expenses. So, and the first thing that you have to do when you want to track expenses is to categorize them, right? So categorizing expenses help businesses identify where money is spent and where savings can be made. Common categories include fixed cost. Here you will have, for example, the rent. Variable cost, for example, the cost of goods sold. You could have here some variable costs related to maybe salaries if you are producing, or even if you are budgeting like a percentage of your sales to marketing expenses, that will also be a variable cost. And then there is discretionary expenses. Each category provides insight into spending patterns and helps prioritize cost-saving measures. And the interesting thing about categories is, okay, so how many categories should I have? How much granularity should I have in categorizing costs? Well, there is not a concrete rule here. I mean, you can have as many categories as you need. That would be the rule. But one advice is, if you have too many categories, then each category will have small amount of money and it won't tell you anything. If you have very few categories, then most of the money will be just in one category, and we tell you anything also, right? So you have to find a balance here in the terms of which category. So for example, let's talk about marketing costs. Let's say that you only invest in Facebook ads. If you only invest in Facebook ads, then you can have just one category that's called marketing costs, because you know that all the money that goes there will go to Facebook ads. But let's say that for your marketing expenses, you invest in Google, Facebook, you also have some TV ads and some radio ads, right? In order to evaluate how much or the efficiency of each of those marketing channels, you have to identify which or how much money you're investing in each of them. So in that case, a category called just marketing expenses, where all that goes into marketing expenses without any tracking, won't be efficient. So maybe you could say, I don't know, social networks expenses and TV and radio expenses. Or you could say Facebook expenses, Google expenses, TV expenses, and radio expenses. So the way you categorize has to make sense to you for cost analysis and decision making. So that's the best way of establishing categories. Then you need tools for cost tracking. So various tools are available to help business track costs more efficiently. Software options like QuickBooks, that it's an accounting software, FreshBooks, or just Excel, for example, can automate tracking and reporting. These tools allow for real-time updates and assist in maintaining accurate financial records. So there are several tools in the market, including some of them that are free, like for example Google Sheets or Google App Sheet. Um, so there are several tools. The more automated that tool is, the better it will work because you will need less time to track costs. But that doesn't mean that if you make just an Excel sheet with the cost, the amount, and the category and the date, just those four columns, that won't be useful. I mean, it will be useful, but you have to keep it updated, right? In the case of software that are more automated or have more automation, they are done automatically, or categorization is automatically, or things like that. So of course that will depend on the size of your business. A small business could just do it with an Excel sheet. A medium-sized business will require some kind of ERP or QuickBooks or something like that, right? Setting up a budget. So now that you have tracked your expenses and you know how much money are you spending in each category, and you have all the categories, you can set up a budget. So a well-structured budget is essential for effective cost monitoring. So when we talk about budget, we are talking about a forecast. So we're talking about allocating money to specific categories. So let's say that in the past you have allocated, I don't know, $100,000 to marketing expenses during the year. But this year you want to grow your company, your business. So you want to spend more. So if you know that last year you've spent $100,000, this year you could maybe, I don't know, allocate $130,000 to to marketing expenses, right? So start analyzing previous expenditures by forecasting future costs, right? Regularly reviewing and adjusting the budget ensures it meets changing business needs, and helps expenses under and keeps expenses under control, right? So if you make a budget, you will have two great advantages. One, you will be in control of how you spend your money because you will have to track it, and you will have to spend the money according to your budget. For example, let's bring the example back, right? So yeah, let's say that you want to spend $130,000 in marketing this year, but the year starts and you start spending money, and you get to July and you discover that you already spent $100,000. So you are way ahead of budget, right? Way ahead of budget. And you should analyze why. Is it because your competition was winning the market, and you wanted um, to to defeat them, so you allocate more money? Is because you were not careful in your money in the campaigns that you were making, and you spend more? Is that extra money that you're spending really bringing more sales, or is it not, right? So first advantage of the budget, you can analyze your costs, and the second one, you can control how you're spending your money, right? So setting up a budget is one of the most important tools and easy to manage tools when we are talking about cost controls and cost efficiency. So once you're tracking your costs and you are budgeting them, the following point is analyzing them, right? So effectively analyzing costs is crucial for identifying business inefficiencies and enhancing overall profitability. Understanding cost reports, KPIs, and industry benchmarks provide valuable insights for informed decision making. So let's start by talking about cost reports. So regularly reviewing cost reports helps business to identify spending patterns and track deviations from the budget. So what is a cost report? A cost report, it's a breakdown reports by it's a breakdown of your expenses by categories and departments to pinpoint areas requiring attention or improvement. So basically what you will do is you have your forecast, you have your budget for next year, you will start tracking each month the actual situation, the real costs, and you will start comparing them against the budget. So there you will see which are the departments that are spending more, that are spending less, which are spending just as the budget told them they should spend. You will be able to see deviations, you will be able to see spending patterns. So where are you spending your money? When are you spending your money? Do you have some seasonality in money spending or not? Do you have some patterns that maybe are not as efficient as it should be, right? So reviewing cost reports regularly is key for improvement. And when I talk about regularly, I'm thinking on a monthly report, right? At least at first. At first, when you're starting doing this, you should follow up on your cost monthly, right? Then once you are an expert in managing your costs and your money, you can do it quarterly. But at the beginning, it's always better to do it monthly. Then you can use key performance indicators, right? So KPIs serve as measurable values that demonstrate how effectively a business is achieving by key objectives. Track KPIs related to costs, such as cost per unit, gross margin, and operating expenses to gauge financial health, right? This is, in general, KPIs are more technical and you have to have like a more advanced knowledge of finance to evaluate them, but they are always a good tool to use when comparing one year against the other, for example, or stuff like that, right? And then another option is to benchmark against industry standards, right? So benchmarking involves comparing business performance metrics to industry standards or competitors. This analysis helps identify best practices areas for improvement and opportunities for cost saving and driving competitiveness. So we always say that, or now in business is like we are always talking about cooperating with your competition, right? Not just competing, but also cooperating, right? And this concept is related to this benchmarking. So let's say that you know your competitors, right? You will always be competing against them um, for new customers, but that doesn't mean that you can cooperate with them and compare your standards. Let's say how percentage of sales are you investing in 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 marketing, and which is the percentage of sales that your competition is investing in marketing, right? Those comparisons help you to think your business better and to know if you're doing something different from your competition, and if that different that you're doing is good or bad. I mean, different can be good or bad also, right? And the last thing we have to talk about cost is identifying inefficiencies. So identifying inefficiencies is crucial to maintaining optimal business operations. By focusing on areas of waste, conducting thorough audits, and leveraging employee feedback, organizations can significantly reduce unnecessary costs and enhance overall profitability. So, which are the common areas of waste? Common areas of waste in businesses include the excess of inventory. This is one that always happens. So companies tend to think that they will always run short of inventory, so they buy more and more and more, and they end up being stuffed stuck with a lot of inventory that they cannot sell, and it's just money being stuck there. But you can always have, like, for example, overstaffing. A lot of companies, when they grow from small to medium size, they tend to start hiring a lot of people because they think that that things are like running out of control, and they tend to hire a lot of people, and in many cases it's more than they really need. So overstaffing is another common area of waste, and also inefficient processes. So here you have like manual processes, for example. Today with automation, there are a lot of automation tools that can automate a lot of administrative processes, and maybe you, I don't know, paying someone for invoicing when there is a software that can automatically invoice and you can save that salary. So these inefficiencies are not only inflate costs, but also hinder productivity and responsiveness to market changes. So if you have a huge cost structure and the market changes and you need to adapt, it will be harder to adapt with a huge cost structure than with a lighter cost structure, with less people, more automation, and less inventory. Conducting cost audits. So cost audits are systematic examination of expenditures aimed at identifying discrepancies and inefficiency. Regular audits can uncover hidden costs and provide insights to optimize financial resources effectively. So cost audits can be done when you are reviewing budgets. Cost audits can be done when you think that a department is spending a lot of money. Cost audits can be done when you have the sensation that your competition has less, or is having less cost of goods than you have. But the most important thing of conducting cost audits is the analysis. You have to be really granular, really specific in the analysis of costs when you do cost audits. In fact, in general, it's really, really recommendable here to hire someone, to hire a financial expert, to hire an expert that helps you to conduct these kind of audits, because you have to be very, very specific to discover really hidden costs. And another way, or an alternative for a cost audit, is the employee feedback. So employee feedback is a valuable resource for identifying inefficiencies within an organization. Why? Well, mainly because employees know their processes and they know when they are doing something that doesn't make sense. So people always know when they are doing something that doesn't make sense. So if you have if your personnel is motivated and it's really engaged within the company, then engaging staff in discussions about processes and systems can reveal insights that can lead to more effective cost management strategies. So always involve people. So once you have done the audits and you have listened to the employees, you can start implementing cost-saving measurements, right? One way to do it is, for example, negotiating with suppliers. So building strong relationship with suppliers can lead to better pricing and terms. Regularly review contracts and negotiate bulk pricing or discounts based on loyalty and volume. A well-negotiated deal can significantly reduce costs. So always be in touch with your suppliers. Always be in touch with your suppliers. Talk to them monthly basis, or once a month. Just talk to them. So see which opportunities you can find to improve that. Find alternative suppliers and show your supplier that you are really looking for an alternative that it's much more or much less expensive than they are, or it's cheaper than they are, or they have better quality than they do and the price is the same. So having a strong relationship and an honest relationship with your supplier will end up in cost saving for sure. Another way is to streamline operations. So examine existing processes to identify inefficiencies. Implementing suitable technologies and automating repetitive tasks can increase productivity while reducing labor costs. And once again, automation, automation, automation. Automation is the key for efficiency, and with the gauge of AI, there's lots of tools that will help you to automate your processes. Engaging employees in the process improvement can also yield valuable insights, as we have already talked. And finally, continuous improvement strategies, right? So adopting a continuous improvement mindset encourages ongoing evaluation of processes. So this is not something, or cost efficiency is not something that you do once. It's something that you have to always do and continue to do. You have to continually improve your cost, continually reduce your cost. So techniques like Lean and Six Sigma provide frameworks for eliminating waste and refining efficiency, ultimately leading to sustained cost reductions. So that's it for this video. I hope you enjoyed, you find it useful. Once again, as I always say, if you need any advice or if you feel that you are need help with your financial decisions, you can always contact us at the description below. So thanks and have a great day. Bye.